What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. All right, welcome back to Real Estate Investing Demystified. Some exciting news in the real estate sector.
There is, yeah, absolutely.
Fed's funds rate has finally dropped.
It's been 4 years since they've dropped rates. So 50 basis points. They weren't even messing around. It wasn't the 25 basis points that the markets were accounting for. It was 50 basis points. So I guess they're pretty comfortable with inflation and the job numbers and everything else. It is an election year, and we're going to an election in 2 months here.
November 5th.
So yeah, I mean, we got a quote on debt today at 4.7%.
Nice.
4.7.
Nice.
So yeah, times are good out there. Is it going to be a bull rush for investors to jump back into the market? For everybody sitting the quote unquote dry powder sitting on the sideline?
That has been sitting on the sideline for a while.
We shall see. Or also a lot of syndicators who are in trouble.
Yeah.
Is this going to save them? And on that topic, our guest today is going to talk to us about syndicators in troubles and LPs and all this good stuff. GPs.
2025. I mean,
yeah,
we had a rate cut in 2024, a few months before 2025.
Yeah. Extend and forget or something, or however,
extend and forget.
however that rhyme goes. But yeah, tell our audience a little bit about our guest today, and we'll start the show. Ava.
Absolutely love to. All right, everybody. We are joined today by Aleksey Chernobelskiy. He advises limited partners, LPs, on existing and future investments. He writes weekly to thousands of investors at lplessons.co to explain how to properly vet and think about LP investments in the grand scheme of their portfolios. Now, Aleksey also helps general partners on matters relating to LPs, such as capital calls or feedback on investment decks. Prior to advising LPs, Aleksey ran Centrio Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. Aleksey graduated from the University of Arizona with a quadruple major in finance, mathematics, economics, and accounting.
Wow. This guy's might be a bit of a nerd over here. You know, I suspect that but awesome. Welcome.
I wasn't so social in college.
You're busy, man. You're busy studying away.
All good. All good.
Welcome to the show, Aleksey. Great to have you here.
Yeah, thank you so much for having me.
Great. Yeah, I heard a tinge of an accent, prior to our show starting. What's your background? How did you make your way to the US? Let's start there.
Came when I was 11. I came when I was 11 from Moscow, straight to Arizona.
Oh, nice. And, that was a change.
The rest is history.
Moscow. Yeah. I've been to Moscow. Beautiful city.
About as opposite as you can get.
yeah. Moscow to Phoenix. Wow. Or Arizona, rather. I'm not sure if Phoenix or not, but interesting. Awesome. 11 years old. Yeah, great. So then talk to us about your career. You got into finance at some point, or asset management, acquisitions. Talk to us about working for an investment firm. How did that all come about?
Yeah, so I held different types of investing roles out of college. I really started like on the algorithmic trading side, actually. Did other types of buy-side stuff, distressed debt, and strategy consulting. Eventually, I moved back to Arizona, and that's when I landed the job at Store. And as you guys noted, the job was pretty interesting. Like I got to oversee pretty big team and a pretty big portfolio, and also there was like really two roles that I had. One was overseeing the existing portfolio, which by the time I left, it was pretty close to 3,000 properties. I think it was like 2,900, give or take. And then also any new deals that came through my team to underwrite and understand risk. And ultimately, I sat on an investment committee to sort of make those decisions for the firm as well. So yeah, that was the experience. That was really fun. Then I went on my own and and ultimately now I advise LPs, as you guys have noted too.
Amazing. Yeah, talk to us about that transition. So you're working for this investment firm. You kind of, you move your way up the ladder, kind of getting to that position you were there, but then you decided to go, into the private sector, or rather, go on your own in your advising business. I know you're pretty active on Twitter as well. I've kind of heard about you on LinkedIn as well, but mainly Twitter retweet. Is it real estate Twitter is retweet, right? I think that's how it goes.
Yeah, yeah,
Yeah, yeah.
yeah.
So was it your involvement with Retweet and Twitter that kind of was the impetus for you to look at possibly going on your own because of the following you were getting on there?
Not really. I wasn't so familiar with, I wasn't so active on LinkedIn or Twitter. I think generally it's pretty hard to be so active on social when you're employed by someone, especially if it's like a public company, etc. But I think, I think the goal was to go out on my own at some point, and the time was right, so I did. And then as part of my, I guess let's call it entrepreneur journey, um, there was no sort of public company um, challenges of stating my own opinions, right? And so I decided to start sharing my thoughts, right? And then so I did that over, I guess roughly now, probably 2 years, pretty consistently, and that's how like the following has started.
Nice, nice. When I first heard about the services you provide, helping out LPs and GPs in some cases as well, but I'm like, that is a service that's needed definitely in our space, because a lot of LPs are kind of have to figure it out themselves. Most times they're wealthy, they're pretty savvy when it comes to investing and knowledge. That's why they're even in this alternative space looking to invest. A lot of times they have to be accredited, so they must have done well in life and made smart decisions. But there isn't really a support network for them, except talking to others who've invested and kind of being referred to an investment firm or a GP to invest with. But your services are really, really helpful. Talk to us about a journey for someone, an LP who is looking for your services. They see you on on Twitter or LinkedIn. They hear about you now. Talk to us about that journey. What does it look like? They reach out to you about wanting to invest. Do you provide them with investment opportunities? Is it they have to have the
Yeah.
opportunity then come to you? Talk to us about kind of the journey they go through.
So it's the latter. I get this question a lot, and maybe I can sort of do a better job of marketing myself. I'm not the best, but I as of right now, at least, I don't connect LPs to opportunities. The only reason I'm engaged is they have found something that they want feedback on. And so they engage me, and I give them my thoughts on the investment and questions to ask and things like that. So that's usually sort of the timeline, if you will.
Okay, that's awesome, Aleksey. And like talk to us about the compensation. How do you get compensated for helping advise limited
Yeah.
partner?
For sure. So for LPs, too, it really depends on some things, but generally it's a flat fee. The result is I like push out a report of like questions to ask the GP, and also my thoughts on the three pillars that I authored. Maybe you guys saw them on Substack, maybe not. Happy to discuss them, obviously, but that's usually how it works. And then that's on the sort of like the new investor side. On the existing investor side, it's a little bit more complicated because some capital calls are very intensive. Some capital calls you could make a decision within 10 minutes. I also think a lot of it is dependent on how much money is at stake, right? It doesn't necessarily make sense that many times people call me and they have, $25,000 invested and they have a capital call. And they want to hire me, but I tell them I just don't think that makes sense. Like financially. Like you can either decide to do the capital call or not do the capital call, but like the the additional expense of hiring me doesn't really like pencil with your like potential returns and potential downside or whatever. So on that side, I tend to go per hour, but again, it sort of varies. If there's something fixed, then I do that.
Interesting. So you work both on the front end when somebody has a deal that they're looking at, they bring it to you and you kind of assess that. And we'll get into detailed questions there. But then you also help them in somewhat of a back end when there is an issue with capital calls or other concerns they might have. You advise them in that capacity.
That's right. Yeah, and I mean, the idea is pretty similar, right? Like the whole business started on the premise that there's a lot of people out there that have money to invest and they believe in these types of investments, but they just don't know the right questions to ask. And I think that's true on the front end, and it's also true when you get surprised by a capital call. I can't tell you how many times I've gotten calls from LPs that they go something like this. It's like a dentist right out of like an operating room, and he's like, "Hey, I got an email. It says something about a capital call. I don't even know what that means. Like, I thought I invested in a deal, and like I already invested. Why are they asking me for money again? Can they even do that? Is that legal? Is that fraud?"
Yeah.
Sometimes they say that, and they just don't know, right? And
Can
so
you
that's
define,
exactly sort of
Alexey,
what.
can you define a capital call, what it means for our audience, for ones who might not understand it?
Yeah, yeah. So there's generally two types of capital calls. Like, generally speaking, it is a need for more money, right? That's like the easiest way to describe it. Um, a need for more money at an investment property can arise for one of two reasons. One is it might have been expected, right? So, for example, there are capital calls, like funds typically will have capital calls where, like, every month or every quarter, you are obligated to send in a quarter of your investment that you committed to, right? So those are not the types of capital calls that I advise on because those are expected. And like, if you committed $2 million, you'll put in 250 every 3 months or whatever the number is. The capital calls we're describing here are where you fully capitalize the deal, and the expectation on the front end was that would be enough to carry you through the exit, and then to get a return and a return of capital and all that stuff. And so all of a sudden, you got a note from a GP that says, "Hey, we ran out of money, and we need to, maybe there's a cash in refi, maybe there is a rate cap that's expiring, and you need to buy something to mitigate that risk. Maybe it's OpEx related. There could be different reasons for it, but that's the idea."
Got it. And in the case of an LP not doing the equity injection that they're requested to do so, they get diluted. So their original investment no longer stays. Is there other issues or concerns that could happen to an LP who doesn't comply with a capital call?
So that itself, it really depends. Like, I've seen many capital calls where the dilution does not occur, right? I've seen some capital calls that like have very severe dilution where you get penalized a lot for not investing. And that's sort of like, in some sense, it's stipulated in the docs. Many times it's not, and it's sort of up to the GP on how they go out on the capital call and how they market it with the rules. Um, I think in terms of risks, I don't think there's any other risk for not investing other than potentially getting diluted. The somewhat complicated aspect of this, which I wrote about at length, was I think there's this concept of um, you're throwing good money after bad, potentially, if it's bad money, right? That's a question of it in its own right to analyze that and understand it. But the idea is it's a sunk cost, right? So like the money that you put in shouldn't matter, right? Where it gets complicated, in my opinion, is if there's a dilution, then then I think it actually does matter, right? Because all of a sudden the capital, like if you do actually think there's a chance for you to get it back and you don't get diluted, then your overall return might make a lot more sense with an investment. Whereas without, you get diluted out and basically go to zero, right? And so the dilution aspect is actually pretty tricky, I think, in terms of like thinking of the last investment as a
Mhm.
sunk cost.
How can a GP motivate their LPs to inject more capital if there is no dilution? Why bother? I mean, of course, the LPs should all be want to save the ship, but again, if there is no
Yep.
penalty, why bother?
Well, I guess a few comments. It's a good question. I think first of all, um, that sort of assumes that they need to motivate them, right? And I think that's maybe a topic in and of itself, because if the capital call presents a good investment opportunity, then perhaps you don't need as much motivation and you don't need as much pressure, right? In other words, like if you presented this capital call to an outside third party and they looked at this and they say, "Oh, yeah, like this is a good investment." That's where you want to be, right? If you're like in sort of a distress scenario, then it gets more difficult, right? And you can sort of either pursue the path of dilution as sort of a fear mechanism, or however you want to call it, right? Or you could say like, like here's the two scenarios, and we're not going to dilute you for not participating, but if you don't participate, this is what's going to happen next. And I think in many cases that's enough, right? Meaning, if in many of these cases, if you don't get enough cash, you will potentially get foreclosed on or whatever, right? And so for many people, that's enough of a motivator in its own right. And I think sometimes I guess installing a little bit too much fear can also backfire, in my opinion.
Got it. Makes
But
sense.
it's a balance, and it's a balance. Like sometimes you need it. Yeah.
Got it.
Aleksey, I was going to ask you, do you provide underwriting support? And the reason why this is a pretty big question is because on a property, I mean, underwriting is one of the key factors, to really showcase if it's going to be a successful investment or not. And we all know that people can really plug in any numbers in underwriting. And of course, for like a busy professional, a dentist, a lawyer, accountant, they don't understand underwriting at all. I mean, it's a very complicated, comprehensive spreadsheet. And it's really difficult to understand. So I'm sure there's a lot of LPs that come to you saying, hey, make sense of this for me.
Yeah, I do that. I mean, I do that partially from in the report. Meaning the initial report is across three pillars. One of those pillars is the property, which might surprise you, but it comes last of the three. And part of the property pillar is like, what's the business plan? Do the comps make sense? Do the sales comps, rent comps, and all that stuff? And also the financials themselves and the underwriting. So I basically go through whatever is presented in the deck and try to give feedback on that. And in some cases, especially if like the invested amounts or potential investment amount is high, so then the LP sometimes asks me to dig further, like to do like a full audit of the model and give them feedback and sort of like dig much deeper.
Got it.
Yeah, that
makes
makes a lot of
sense.
sense.
That makes sense. Go ahead.
He's got me really curious now because you've mentioned this a couple times. What are the three pillars? The third one's the property, right? Talk to me about the first two.
So I intentionally put them in this order. And again, like I think some people get surprised because the third one is the property itself.
Is pillar
But I
one
think
the
it's
most important? Pillar one's the most
yeah,
important down to the
meaning you're
pillar?
investing, it's kind of weird. Like you're investing in a property, but I think pillar three is for the property.
Okay.
Surprise. That's my opinion. Maybe I'm wrong, but that's the way I think about it. So the first one is execution, which is like the GP's ability to execute, which entails a lot of things. Like, have they been involved in lawsuits that like are, but potentially maybe like presenting ethical challenges in terms of like trusting them, right? Have they had experience with that same asset class? Have they ran a deal on their own before? Have they had an exit, and how did they look? Like all that stuff, right? So all of that sort of is within the execution pillar. And the reason that's important, and number one, is because at the end of the day, as soon as you sign that check, like everything else essentially is up to the GP. And so you really have to make sure that they know what they're doing, they've done it before, and you can trust them. Right. And so that's what I'm checking for there. And then and the second pillar is alignment of interests. In other words, someone might know what they're doing and they've done it before, but like if your alignment is off, then especially in bad times, things start diverging. And so on the alignment of interests pillar, I check for three things in groupings, so to speak. It would be like the fees that they charge, the co-invest of the GP that they're putting in, how that relates to the acquisition fee in terms of dollars. And then the third thing is just the waterfall and the pref. So like, what is the split and what's the pref? And so all of that together sort of
even I'm guessing even an existence of a pref or hurdle, because in some cases there is no pref. A lot of deals I've seen.
Yeah, and I'm this might surprise you, but I would say there are cases where it's okay that there's no pref. In other words, all investments in general should, and this is where I think some LPs have a hard time with me, but like I think investments are all relative in a sense, right? And so you need to have a big enough framework for them to understand that, like, just for example, you just said no pref, but what if I told you that the split was 95-5? For example. So is that better than a 70-30 split with an 8% pref? Well, they have pros and cons, but it's not an immediate no, right? So, but what some LPs want to do sometimes is they look at a deck and they're like, and sometimes they'll get these calls like this guy's charging, you know, the 5% acquisition fee, but they didn't realize it's 5% and $1 million, right? So like there's a lot of these things that are like very relative. And I think in a sense that's why I exist, because they're hard to like piece together all in one place.
For sure. Yeah, there's a lot
Yep.
to each deal.
We have a lot of questions, so I'm just trying to kind of bang through a few of these. So you also advise GPs. Talk to us about what you do there as far as kind of helping GPs out. I know you look at GPs pitch deck. How else you said in your bio, you talks about advising them on capital calls. Talk to us about this briefly.
Right. So my main business is the LP side, right? But when there are no conflicts with that existing GP, and if they ask me to look at a deck, then I'll provide them feedback. The idea of that is, pretty simple. I think LPs are not the best at communicating like what they wish they would have seen in the deck. Many times they pass and don't really express their reasons. They just say, "Oh, like, I changed my mind," or "I'm a liquid," or whatever, but they didn't mention the fact that like the deck that they looked at was like not so informative, or like there was a mistake or whatever. Right. So that was the idea, is like I sort of understand the LP side of the business pretty well at this point, and so I can give them feedback on the deck. On the capital calls, I don't do a ton of those, but from time to time, like, just I did one last month, for example, like someone had a pretty big capital call, and in confidence they came to me and they're like, I'm not exactly sure how to like communicate this. And to your point, I'm not sure, like, should there be a penalty? Should there not be a penalty? It's a fair capital call to even ask for. Like, I believe in it, but can you check my math? So like a lot of questions surrounding that, and like strategy I've helped with as well.
Got it. So before the show, I came up with this with an idea. I was going to share it with you, but I want royalties before sharing this with you, Aleksey. But I was thinking about a verification process where GPs come to you to get verified, and they get Aleksey verified GP, and they're able to take that logo and put it on their website because they've been verified through you. You put a stamp of approval on that GP. You've checked their background. You make sure they've never lost investor money or been unscrupulous or had any lawsuits, and that they regularly get all their investments checked by you. So they get that verified. Have you ever thought about that? I'm joking aside. Have you ever thought about that? This idea of verified, Aleksey verified?
Yeah. I don't know if I would call it that, but yeah, meaning I think about a year ago I thought about that, and I also thought, I mean, the way that I really think about it is it's similar to like S&P and Moody credit ratings, right? Meaning they rate corporate bonds and those types of instruments, and so as of right now, as far as I know, like there's no rating system for GPs. Um, the reason why this is pretty complicated, and I haven't like I've given it some thought, but I haven't went after it, is because first of all, it requires like pretty deep knowledge of the GP itself. In other words, you could do good deals, but the GP entity itself is not in a good cash position, and that could jeopardize their investments. The opposite is also true. You might have like a very strong and credit-worthy GP in terms of that entity and its creditworthiness, but it's doing deals that are not so good, right? And so, in a sense, it's almost like an ongoing rating, right? That's where I like struggle a little bit, because you could probably put a credit rating on the GP entity, but the GP entity does not say a whole lot about the next deal that they're doing.
And also
Says
partnerships
something,
as well. Partnerships are fluid. Sometimes we've seen a lot of GPs, especially when the rates start going up and distress start coming. A lot of GPs, there was like three of them, and then one of them disappears. We're like, where is he? The third guy has disappeared. He's not on their website anymore.
Right.
So like
Exactly.
what happens? Is it still the same team? Was there a hostile some hostility? Did one of them
Yeah, that makes a whole lot of sense. You
Right.
always have to do it by deal basis.
Yes,
because it depends on how conservative they underwrote. It depends on so many different factors.
Or like Aleksey said, ongoing. Every year they go through the process. GP pays a fee. They go through the process, they get re-verified, make sure there's no criminal offenses, no lawsuits, no investor capital loss, no huge complaints. Check out their Google rating. We saw a GP recently who's lost some money, big GP, well-known GP, and their Google rating was 5, now sitting at like 1.5, and the comments there are just unbelievable. But let's continue. Again, we have a lot of stuff we want to discuss here. Do you want to go over this one briefly?
Aleksey, like what is your LP profile? Are you working with the newer investors? Are you working with sophisticated investors? Are you working with people who just learned about syndication and they're really good at the S&P 500? Like talk to us a little bit about that, please.
It's interesting. I mean, I think the business started with a pretty specific target audience, which is, like your dentist, your software engineer, lawyer, right? Like someone who is not in this business day to day, but wants to invest. Over time, because I've sort of developed a database of what's happening in the marketplace, I've started to hear from the more institutional side, family offices. And so part of that is because, they might be interested in investing in a deal, but I have a lot of information on their existing deals that might not be public. In other words, like they're still the owner of that property on CoStar, but CoStar doesn't know the fact that distributions have stopped and they issued 3 capital calls, right? But I've spoken to maybe 5 or 10 LPs over the past, however months that have told me like, hey, like I have this information and that information. I've sort of like put it all together. And I think overall the premise is, can I, at least do some legwork in terms of the opaqueness in this like GPLP marketplace.
Mm.
Nice.
Got
And
it.
then do you have investors who keep coming back to you? Because I mean, it's the check size is 50K, 100K. So they say, hey, Aleksey, approve this investment for me. Or you don't necessarily, I guess you kind of put your stamp of approval on it, but don't tell them to invest in it.
Right, that's right. So yeah, so I don't approve. The way that I see my role is to help them understand the risks.
Yes.
And approvals almost don't make sense because like investments, just because investment is good does not mean it doesn't carry risk, right? They could still lose money. But my job is to make sure they understand the paths in which they get money and the paths in which they lose money, right? And as long as they sort of go into the investment and they understand both of those fairly well, I sort of consider that a success.
Nice.
Well, yeah, when we were prepping for this show, an idea came to mind for me, and I was, this is a juicy part of the podcast for sure, and I was excited about it. When you got into this space, again, sometimes we have preconceived notions when we get into an industry or a service that we want to provide, and sometimes when we get in, it actually the situation is much different. It shocks us, it surprises us. Sometimes it ends up, being exactly how we thought. And when you got into the space and you started seeing LPs contacting you with situations they had with GPs and so on, were you surprised about what were you surprised? What surprised you? Was there something super unscrupulous that you saw, borderline fraud? Was there the naivety of, or naiveness, I'm not sure which one is the right word, but of the LPs that you noticed that how could this person go and invest $500,000, a fortune with a GP without even Googling the guy's name? What were you surprised and shocked? And if you can share some stories without having to give a detail, that would be great.
Yeah, I think there's been a lot of surprises. It's a really good question. I don't think anyone has asked me before. So I think maybe the biggest surprise, I'll try to go in order. I don't know if it'll be perfect, but the biggest surprise is fairly large and what I would consider to be pretty sophisticated sponsors, or at least what I thought to be sophisticated, using the word guaranteed returns and stuff.
I made a comment on that one on LinkedIn. When I saw that post from a very big syndicator, I actually made a comment on LinkedIn about it, and I said, "Yeah, I didn't." But keep going.
Yeah, and I wrote like a whole article on it. I mean, people can look it up, but it's like even if they're personally guaranteeing something, and even if they're pretty wealthy, that's not the same because then you have to underwrite their personal balance sheet, and no one is giving you that. right? So, but that's, that's for another time. So, I mean, I think that was surprising. Like, it's interesting. It's less surprising if it's like someone that has one deal and it's their first thing and they don't understand. Maybe that's excusable. I'm not sure. But like, when it's someone that is, raising substantial amounts and has done it for years, it was pretty surprising. Um, I think capital calls is another big one. Um, I definitely underestimated how misaligned the interests between the GP and the LP can get in distress. In other words, I've seen many situations where a capital call was issued, and it's all the same language. It's like you have 3 days to make a decision. If you don't contribute your money, we're going to lose the property by next week. And oh, by the way, like we sort of have a plan, but we'll send you something in 2 weeks. Um, and if you don't invest, we're going to cram you down, basically. Like it's like this the same template. And that itself is not great. But what I'm referring to here is like once you actually do the math and you realize that like the property is worth, in some cases, I've seen 50% of the debt balance. And so then you're like, so what is the plan? Like, meaning you're sending this email out to a bunch of retail LPs that don't really understand how to make these decisions. And you're putting pressure on them, and you didn't really provide the analysis. And then once you dig in, you realize that there's just no chance, even if rates drop to zero again, like there's no chance that this property is coming back to returning $1 in equity back. Like you're not even going to be able to pay the debt balance back. And so, those situations really surprised me because it sort of like starts to border on ethics, right? And misalignment of interest, because you can have a situation where like the GP isn't being fully honest and they're just trying to sort of like kick the can down the road.
So what do you think it is?
Yeah, like,
Do
why even
do
do
do you
capital?
think do you think that is that figure of speech kind of kick the can down the road, or is it incompetence?
I think I've seen both. I think I've seen both. Like meaning I've seen cases where I mean I've seen cases where the GPs themselves don't really know if the capital call makes sense, right? And you start asking questions and they didn't even understand like what they presented in the first place. Um, and I've also seen cases where that they're just I think not being so ethical. In other words, they know that this is like a 1% chance of happening, but the alternative is to get foreclosed on. Oh, but wait, like we have 3 deals that we're raising for right now. We can't have that press release go out, and we can't have that like real deal article about us or whatever. And so, I mean, it's hard for me to comment on how difficult it is. It obviously is.
Yes.
But at the end of the day, what happens is they sort of put those investors and their fiduciary duty to them aside for their own benefit. And that's where the misalignment starts happening.
Got it. Talking about real deal and what have you, I read somewhere that you actually, I might be on your Twitter page, that you actually say, send me anonymous emails. Do you get information from, anonymous sources where, hey, ABC investment firm is in great trouble. They're doing capital calls. They've lost, they give the keys back. Are you somewhat involved in that space as well when it comes to like reporting type of, like a reporter type of work?
Yeah, I do get those. I'm not I don't like sort of like publicly share these things. I'm not like, a newspaper by any means, and I don't intend to become one. But like it's the opposite, meaning the reason why it's important is if an LP is in a deal, let's say with XYZ GP, and they just got a capital call, or let's say they even got foreclosed on, right, today. And then tomorrow, another LP reaches out and says, hey, what do you think about XYZ GP? Like they just sent me this deck, can you review it? And so without that tip from the first LP, I wouldn't see in CoStar that their existing property is in foreclosure. Right. So again, it's sort of like this ecosystem of trying to the best of my ability to bridge the gap between like real-time information and what LPs need to understand when they're going into deals.
Sure. Let me throw a hypothetical and sometimes hypotheticals are difficult to answer. An LP brings you a deal. You have a look at it, and no matter how you kind of try to make sense of it, it smells like a scam. It seems like a fraud. It's either a Ponzi. The returns are ridiculous. You do a search on the group. They don't seem real. I know this is more in probably the crypto world than the real estate world, but what are the steps you would take if you did see a deal where you feel personally that it might be an actual scam, a Ponzi, not incompetence, not somebody getting over their skis, which happens in real estate, but I'm talking about an actual Ponzi?
Um, I don't think I've had that happen.
Right.
And I think LPs they really like to assume things are Ponzi's and frauds, but like, stopping distributions and issuing capital calls is not either of those, and many times it's in the best interest of the LP. Not always, as we've discussed, but yeah, but I don't think I've encountered something at that level. Um, I've been a part of many situations where, there was like a breach of fiduciary duty that was very material, um, maybe misrepresentation, right? But I wouldn't like sort of like bucket that into like let's call it SEC type of thing.
Got it. Got it. That makes sense. Let's talk about debt a bit here. I mean, debt is, in my opinion, very foundational to real estate. Real estate in some cases has beaten it, index funds and equities and S&P because you can have this leverage. But also at the same time, it's a double-edged sword where it helps you, it boosts your returns, it allows us real estate investors to scale and do business. But at the same time, if you don't put the right debt on the property, or you find yourself, with your pants down when the tides go out, it's not a good circumstance. How big of a factor is debt and the way that the GP has structured their capital stack, mostly debt? How important is that when you're advising a client?
Well, so now that we talked about the three pillars, there's three pillars. Of those three pillars, the third one is the property. And within the property, part of that is leverage, right? And in particular, what debt are they using? What are the implications of that, such as is it floating, and what happens if it floats up, right, as a risk factor? Is there a maturity coming up, etc. Right? And so I think it's certainly important, right? I think it's especially important if you're thinking about um, trying to build a sensitivity table. I would call it of sort of, in terms of sensitivity tables, it's probably in the same, it's like, it's maybe younger brother or
Yeah, but
sister
Alexei, I
of,
wasn't talking about more about kind of, I was talking about syndicators
yeah,
really, bringing debt to all the way up to the neck of the deal. They have the senior debt, they have the supplemental, they have pref equity, everything you can imagine on there to be able to
yep.
financially engineer those types of LP economics. That right there, is that a absolute red flag and an absolute X on the deal for your investors when you see such a thing, which seems to be somewhat common?
So I don't see that often. I've seen it, obviously. I would say it depends on which part of the stack you're participating in, right? Um, Different parts of the stack will have different economics, and it might make sense to, like, let's say, be inside of the pref, but not be inside of the regular equity. Um, in terms of it being a red flag, I mean, all else equal, it just means you have less room for error, right? And so I think that would be very apparent once you run a sensitivity table on like exit cap rates or interest or NOI changing, right? And so that becomes pretty obvious, I think, in my analysis and to the LPs, because, like if you only put 5% of equity in, if the property value drops by 5%, like your equity is gone. Right now, if you're this is where I think people get confused. They assume, oh, it's okay, like single family homes go down in value too all the time. But if you hold on forever, it ends up being fine. And that's true, except single family homes have 30-year mortgages. And that's what you're alluding to. What's really important inside of the stack is the fact that you have like these staggered maturities. Like the pref is doing it here, and then you have a mez, and then you have a senior, right? And all of them have like, really is just like sort of another cook in the kitchen, right? And like when they come call you, it might be, you just might be upside down, and it might be bad timing for you to pay off that loan.
Mm, got it. When it comes to the world of investing, I always define it this way. I'm like, always look at the most secure, low risk, almost no risk investment, which is US, government bonds, treasuries, right? That's where everything starts from. If that's sitting at 5%, if you can get 5% on a government bond, and today I think it's sitting at 10-year treasuries, what is that? At
3.6.
yeah, 3.6 sitting at. But if that should be the base, you can get almost guaranteed money, return on your investment at 3.5 or 4. It was 5 for a while. It should always be from there up, and that goes really by risk. The more risk you're willing to take, the more return you should be able to take, right? So that's kind of the basis. But when it comes to the world of investing, aside from that, we also want to look at options.
Yeah.
And index funds are one of those options.
Yeah, and like if the S&P 500 is so great, why bother with syndications, in your opinion, Aleksey? And Blackstone was recently able to raise for a $10 billion fund not too long ago. So let's talk about that a little bit.
Why bother even with Blackstone if if you can just put it in an S&P, make 8% compounded for the last 100 years in the 500 top best companies in the US, or I think is at least on the exchange in the US, it might be so that
why bother?
Yeah,
why bother?
Yeah. Well, so I think the only answer to that, there can only be two answers to that. Either you're just interested and you want to learn, right? Meaning it's not a financial decision, right? Or it is a financial decision and you're looking for a risk premium over the S&P. So those are really, I think, in my opinion, the only two answers. Now, to answer your question more broadly, I pretty strongly believe that many people that participated in syndications over the past few years should not have. And that's not a statement based on like, hey, you invested in a bad deal, and in hindsight, you shouldn't have. But my point is, they're not the return on hassle, so to speak, on like properly diligencing a deal where you invest 10 grand and you got 5 grand in return, but you spent like 15 hours trying to understand it and you have all this headaches and like understanding the reporting and all this stuff, like it's just not worth it, in my opinion. Right now, again, you might go back and say, well, it's not a financial decision to me. Like I just want to learn about investments and this is how I'm doing it. But that's sort of not financial anymore. You know what I'm saying? And on vice versa, I would also say there's quite a few very wealthy people that I think should have exposure to syndications, and especially like their tax benefits in many cases that don't. So I sort of I think my hunch is that both of those worlds will sort of, or populations will sort of adjust over time.
Yeah, but the second part of Ava's question was about this the recent $10 billion fund that Blackstone put together, I think focused on multifamily as well. But there's also these huge funds, that are being put together now to come back into the market, and they're happening all the time. They're putting these funds, and when we look at the allocations of a lot of institutional investors, family offices, university endowments, funds, sovereign wealth funds, they all have an allocation to these types of syndicated real estate deals. But the idea here is this is not just your retail who's coming in and exploring and being adventurous and coming into the space and putting some money into this syndication, and they can get this intimate GP that talks to them, that can touch it. It's not like a REIT where you don't know. There's so many different levels within that place. You have no idea who you're talking to. You're just a number. Whereas it gives you that intimate feeling of investing, and you trust in someone, and you work together, you make a bunch of money. It kind of is glamorous. It's sexy in some ways, but the institutions are doing it as well. Why bother when they could have just put it into an index fund? I mean, the question was more not only on retail, but on the institutional level. Why is there such a large allocation into the alternatives for these large funds that have investment committees that are, that are full of economists and really smart people? They still allocate to these types of investments.
Well, I think maybe the premise in what you're asking is like there shouldn't be. I would assume there should be. Maybe the question is how much it should be, right? In other words, that's what a lot of people are struggling with. There's no question that you should be diversified, and at some level of wealth and like experience in terms of diligence, like sure you expect to have sort of like a broad range of like different types of investments, and one of those would presumably be real estate. I don't see why not, or real assets in general, right?
Mm.
Um, in terms of like comparing syndications to REITs, which you mentioned, I think that's also a pretty intricate topic. You know, it is true what you're saying. In other words, in other words, like yeah, there's sort of like I mean, I used to work at a public REIT, right? So like yeah, you don't really get to touch the assets, you don't really get to speak to the CEO, but at the same time, it takes a lot to become a public company, right? Generally, I would say all else equal, REITs are much better run than your average GP because it's not a startup anymore. Like they had to get through a level of diligence to get to be listed,
But they
right?
have way heavier
And
fees too, though, Alexei. The fees are much heavier than your run-of-the-mill syndication.
If you're talking about private ones, that's true. REIT fees are in many cases a fraction of what a regular GP would charge because they spread those fees across a much bigger portfolio,
How come
right?
they
And
yield
and
so much
there's
less then? How come they're yielding so much less than syndications?
you're talking about dividend yield?
I mean, no, just overall yield on if you're investing in public REIT, historically, what are they? They're still in single digits. You're not in the teens, whereas syndications, if you're not making 15% AAR, there's no point of investing in it.
Well, I mean, I think you would have to compare like to like. And I personally haven't seen like a good study, which would be very interesting. But like what you're saying is like I agree, like hypothetically you should invest, and if you're not making like, low teens or mid teens, it doesn't make sense. But people, I would say, generally don't invest into REITs for like low teens type of risk. The idea is like it's a low risk type of investment. It's diversified across um, a much larger pool of assets generally within a REIT. And also, like I think this is important. Like it has liquidity. Like that's worth something, right? Whereas a syndication, like you give your money out and you hopefully you did your diligence, you gave it to the right person, but you don't have control over it at that point. So even if you need it, um, you just can't get it, right? Until the exit occurs.
Yeah, you're committed.
Got it. Hey, we really appreciate all the advice and wisdom and transparency and sharing of that with us. We learned lots and really enjoyed it. Let's get to the next segment of the show here. And
All right. Okay. It's the 10 championship rounds to financial freedom. Lexi, are you ready for the questions?
I'm not sure.
Whatever comes top of mind. Okay, here we go.
ready or not, here we go.
Ready or not, here we go. First question. Who's been the most influential person in your life?
I think my dad, probably. Somewhere between my dad and my mom for different reasons.
Very nice.
Nice,
Awesome.
nice.
Love that. Next question. What is the number one book you'd recommend?
I really like Deep Work by Cal Newport.
Nice. Nice.
Okay. If you had the opportunity to travel back in time, what advice would you give your younger self?
More internships and less majors.
All right. That's a good one.
Okay. All right. Next question. What's the best investment you've ever made?
Getting married, probably.
Nice.
Now, what's the worst investment you've ever made, and what lessons did you learn from it?
At some point I got excited about like putting my money in the stock market, and I didn't know how much. So I put in like all of my savings, and then like a month later it dropped 15% and I freaked out.
Oh, no.
And I didn't like I wasn't well versed enough to understand that you should just keep it in and etc. So that's probably it.
All right. Next question. How much would you need in the bank to retire today? What's your number?
I've never thought about this, and my wife, I've actually talked to my wife about this, and she thinks I would never retire.
Nice.
So I'm not sure that your number exists.
Nice. Nice.
Something to think about now.
Yeah, maybe I should.
All right, next question. If you could have dinner with someone dead or alive, who would it be?
My dad, definitely.
Now, if you weren't doing what you're doing today, what would you be doing now?
Meaning like right now?
Yeah, if you could be a
Um,
race car driver or a tennis player, if there's something else in the world that
professionally.
yeah, professionally, like is there something else you could have pursued in life?
Yeah, so I played table tennis professionally back in the day, but I sort of like decided to pursue college and stuff. So I think it would be fun to go back
All
and,
right.
Nice,
and try the
nice.
sports route.
Fun.
Nice.
Awesome. Okay, my favorite question.
You're asking this from a quadruple major
I know,
guy
I know.
here.
I'm excited to hear your response to this one, Aleksey. Book smarts or street smarts?
Oh man. I think in college I would have obviously told you book smarts. But I've learned since that book smarts, I think, generally matter way less than street smarts if you're optimizing for like financial success.
Nice answer.
Nice. All right, last question, Aleksey. If you had $1 million in cash and you had to make one investment today, what would it be?
I would put it into treasuries and then find a great investment.
There you go. Very risk averse. Nice. Awesome. Go ahead.
Awesome, Aleksey. Let everybody know what's the best way that they can reach you, please.
Yeah, so my name is pretty easy to find. I tweet on Twitter or X, and then I'm pretty active on LinkedIn. You can find my newsletters on lplessons.co, and can always reach out to me as well. The email is Aleksey, Aleksey @hey.com.
And we'll share that in the show notes. Thank you so much for being here. Thanks for your advice and wisdom. Really appreciate you, Aleksey.
Thanks, Aleksey.
Thank you. Thank you guys for taking the time.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.